Welcome back. You're with Money, 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 and we are talking taxes this week. So yes, tax filing season is around the corner. We've just set the record straight on Aadhaar and PAN and the linkage between the two. What are the other things that one needs to keep in mind, Archit, as we're getting ready? Because the ITR form itself has changed this year, right?
That's right. So I think a few very important considerations, right? One, let's talk about when folks have a business or they are filing as a proprietor or those kind of cases. So there was there was a simplification in the ITR forms. So the government went ahead and reduced the number of ITR forms. So let me talk about that first from a business perspective as an individual running a business. So there used to be an ITR 4S and the ITR 4 for businesses. Now that has changed. The ITR 4S has been discontinued, but that is the form which where people could declare income under presumptive income. So it's a very popular tax form, and that has been renamed to ITR 4. So that's a bit confusing, but ITR 4S has become ITR 4. The erstwhile ITR 4, the last year's ITR 4 is now ITR 3. So this is a complex name change, but just stay with me. The other one is the ITR 2A has been discontinued, and there's a new simpler ITR 1 and ITR 2 which has come into play. The ITR 1 is for folks who earn less than 50 lakh rupees income, do not have foreign assets, basically people who have simpler tax returns, which basically means you have income from salary, house property, and so on, and you have a simple case. That's the ITR 1, and for every other thing it's ITR 2. For business, you need to think about ITR 3 and ITR 4 now. ITR 4 is where you declare your presumptive income. Okay, so important pointers to keep in mind as we're getting ready to file our tax returns, with, of course, the forms having changed to begin with. Now, Harsh, another slightly complicated issue, and this dates back to the budget day. Because that's when, the statement was made that if you have not paid STT or securities transaction tax on any sort of, purchase or sale of shares, then there might be a case that you do not enjoy the exemption from long-term capital gains tax even after you've held those shares for 1 year. So there was a flutter in the market, and everybody was wondering what happens if I've got old bonus shares or ESOPs, prior to 2004. There is a clarification, I believe, that's come through. What is the current status?
STT came into effect from 1st October 2004. And the purpose was that anybody who has paid STT, and you pay STT only when you transact on a recognized stock exchange. And if you've held those shares for more than 1 year, then all the gains that you've made is exempt from tax. If you have acquired shares post 1st October 2004, you should have paid STT on both legs of your transaction. That is at the time of acquiring the shares and at the time of sale of shares. Now, this is an issue because now if in case you've been allotted shares through an ESOP, if you've got bonus shares, there is no instance of STT on those transactions. So to ease that, the government came out with final notifications now. So if I may just read out, because they will have exactly those words of the notification.
Sure.
All those acquisitions of listed shares approved by Supreme Court, High Court, National Company Laws Tribunal, SEBI, or Reserve Bank of India. That's the first. So all those shares which are acquired by a person as a result of some
action that's happened, or a regulator stepping in, and therefore you acquiring the shares.
So in that case, there is no chances of any bogus transactions taking place. So there is no element of evasion of tax in there. So any shares that you acquired through such approvals, then
you continue to get the benefit of the LTCG exemption.
Absolutely. The second condition says the acquisition of shares by scheduled bank, reconstruction or securitization companies or public financial institutions during the ordinary course of business. So they've exempted even those institutions from paying STT at the time of acquiring those shares. Now, as well, foreign direct investments and employee stock option schemes has been very specifically mentioned.
Yeah, so this was, I think, the important clarity that everybody wanted. What happens to your ESOPs, which the company gave you prior to 2004, and then if you go in the market and encash them, then what happens?
So exactly. So that has been categorically specified and said that any employee stock option schemes are exempted from this condition of having paid STT on both the legs of transaction. Now, acquisition by specified venture funds, of course, or investment funds or qualified institutional buyers, because the allocation of shares in such cases is directly by the company. So there is no instance of STT being paid. So these are the 4 categories that has been very specifically mentioned. Now, there is an ambiguity on what about shares which are acquired otherwise. So in those cases also, there is an exemption list which has been mentioned, and there are 3 conditions on that as well. Now, in such cases, now the conditions that we're going to say is for those shares in which long-term capital gains benefit will not be given.
Okay.
In spite of the fact that it was you have bought it through and not paid STT at the time of buying. So now, if you've acquired shares of listed shares in a preferential issue of a company, whose shares are not frequently traded on recognized stock exchange. So there is a company that usually we see many a times that there are thinly traded companies. They are listed on the exchange, but the trades do not happen in huge volumes. Now there is a possibility, and that used to be some cases that Income Tax Department has unearthed in the past, where shares were allotted as preference shares. On a one-to-one basis, it was not
on an exchange, so there was no STT paid.
Absolutely.
So therefore, those kind of transactions are going to be under the scanner.
Under the scanner, and you will not be eligible to get the long-term capital gains.
You will have to pay long-term capital gains.
Absolutely. Okay. Another condition is if you've acquired shares of a company which is already listed, and then you have acquired it, like me and you get into a transaction to buy shares of, say, Reliance, for instance. While they're already listed on the exchange, why should we transact with each other?
We're doing off-market trades.
When we do an off-market transaction. So it says acquisition of existing listed equity shares in a company not through a recognized stock exchange. So while it's already listed, what is the need for you to buy and sell independently amongst each other? The third is acquisition of shares of a company during the period of its delisting. So which means if a company was listed, then it went into delisting, and then it listed back. In that period, if you acquired the shares amongst each other, not through the exchange because it was not listed there, still you will not be getting the benefit of long-term capital gains because you have to pay, in all such cases, you have not paid STT on both legs, at the time of acquiring and at the time of sale.
Okay, fairly complicated, but important to keep in mind, depending on the transactions and the stock trades that people may be having. We'll take a break on that note. On the other side, we'll answer some of the queries that our viewers have and also give you a quick bird's eye view of what the onset of the GST could mean for your insurance and your mutual fund investments.